everyone. I am Shalini Singh, Assistant Professor in Department of Commerce at GIMS Engineering Management Technical Campus, Greater Noida. So, today in this lecture series of income tax law and practices, we are continuing with our lecture of computation of incomes from house property. As in the last class, we discussed what is an income from house property. So, its income from house property is one of the important heads of income under the Income Tax Act, which helps in the calculation of gross total income of an individual. The taxpayer have been in particular keen to know about the exemptions and deductions available to them on the repayment of the interest and principals of the loan obtained to purchase the house property. If that house property is let out or self-occupied, then what should be the procedure? So, in this lecture series of unit 3, we'll discuss about the assessment of income from house property. So, this is the condition where house which is let and was vacant during the whole period, or the part of the previous year. So, first of all, gross annual value where the property is let and was vacant for the part of the year and the actual rent received or receivable is more than the reasonable expected rent in spite of vacancy period. In this, the gross total annual value will be the sum for which the property might reasonably be expected to be let from year to year, or actual rent received or receivable, whichever is the higher, that will be taken in the gross annual value of the house property. Then in second case, if the gross annual value where the property is let and was vacant for the whole or part period, the actual rent received or receivable owing to such vacancy is less than the expected rent, then the annual value of the property shall be determined under three situations if all the following three conditions are satisfied. That is, number 1, the property is let; number 2, it was vacant during the whole or the part of the previous year; number 3, owing to such vacancy the actual rent received or receivable is less than the expected rent. So, in this case, the gross annual value shall be actually the rent received or receivable. When then there is a third situation where the house property which is a part of the year let and the part of year occupied for the own residence. Where the house property is part of the year let and the part of year occupied for own residence, its annual value shall be determined as per the provisions relating to let out property. In this case, the period of occupation of property for own residence shall be irrelevant and the annual value of such house property shall be determined as if it is let. Hence, the expected rent shall be taken for the full year, but the actual rent received or receivable shall be taken only for the period let. So, if we see the three conditions, how the annual value is determined in case of self-occupied property, that was in the first case. In case of self-occupied house property which was not actually been let out any time, the annual value is taken as nil, and if one is having more than one house property until all of them for self-occupation, he is entitled to exercise an option in terms of which the value of one house property as specified by him will be taken as a nil, and the annual value of other self-occupied properties will be determined as the notional basis as if they had been let out. And then annual value of one house away from the workplace, a person may own a house property say in Bangalore which he normally uses for his residence. He is transferred to a Chennai where he does not own any property and stays in a rental accommodation. In such case, the house property in Bangalore cannot be used for self occupation and notional income. Therefore, it would be normally have been chargeable through, although he derives no benefit from that property. To save the taxpayer from the hardship in such situation, it has been specifically provided that the annual property of such property would be taken as nil, subject to that condition that the assessee must be the owner of only one house property and he is not able to occupy the house property because of his employment. and the property should have been actually let, and he has to reside at a place of employment in a building not belonging to him, and he does not derive any other benefit. Then how to derive annual value in case of a property which is let out, a house property. So, in this respect of let out house property, the rent received is the actual rent received is usually taken as the annual lettable value, where however the rent is not indicative of the actual earning capacity of the house, and the notional annual value will have to be found and adopted. So, the standard rent would be the annual value in case of properties subject to the rent control legislation. However, when the actual rent received or receivable is higher than the notional values as calculated, the higher figure will be taken for the purpose of income tax. So, for the annual value as it is determined, municipal tax has to be deducted if the conditions like the property is let out during the whole period of part in the previous year, and municipal tax must be borne by the landlord, and the municipal tax must be paid during the year where the municipal taxes have become due, but have not been actually paid. So, this will not be allowed. So, municipal tax may be claimed on the payment basis, that is only in the year they are paid if the taxes belong to the different years. Amount let after deduction of municipal tax is net annual value, and other permissible deductions from annual value in case of let out properties. And if we see in case of when in case of property that has been let out, that is in the third one, the house property which is a part of the year let and part of the year occupied for the own residence, then in this the matter is set off and carry forward losses from let out properties. So, whether how in this case the period of occupation of the property for the own residence shall be irrelevant, and the annual value of such house property shall be determined as it has been let out. Now, what is the treatment of unrealized rent? So, the actual rent received or receivable shall not be included, shall not include the amount of rent which the owner can realize, subject to the rules made in this behalf. So, unrealized rent where there is a kind of a pre-construction or it has not yet been constructed. So, money may be borrowed prior to the acquisition of the property. In such case, interest paid or payable before the final completion or acquisition of the property will be aggregated, and it will be allowed for 5 successive financial years starting with the year in which the acquisition or the construction is completed. So, the unrealized rent shall be excluded from the rent received or receivable only if the 3 conditions are fulfilled, that is the tenancy is bona fide and the defaulting tenant has vacated or steps have been taken to compel him to vacate the property. The defaulting tenant is not in occupation of any other property of the SSC, and the SSC has taken all the reasonable steps to institute legal proceedings for the recovery of unpaid rent or satisfies the assessee officer that legal proceedings would be useless. So, unrealized rent subsequently recovered would be taxable in the year of receipt, and it has been mentioned earlier that the basic requirement for the assessment of property income is the ownership of the property. However, in the case where the unrealized rent is subsequently realized, it is not necessary that the SSC continues to be the owner of the property in the year of the receipt. Now comes what are the deductions in from the income from house property. So, income chargeable under the head income from house property shall be computed after making following deduction. So, what are these deductions? Let us see. Statutory deduction number 1. So, from the net annual value, the assessee shall be allowed a statutory deduction of sum equal to 30% of the net asset value. This deduction is allowed towards the repairs and collection of the rent of the property irrespective of any expenditure incurred. Then we have interest on borrowed capitals. So, where the property has been acquired or constructed, repaired, renewed or reconstructed with the borrowed capital, the amount of interest payable on such capital is allowed as the deduction. So, interest on borrowing can be claimed as deduction only by the person who has acquired or constructed the property with the borrowed fund. It is not available to the successor of the property. In other words, the relationship of the borrower and lender must come into existence before it can be said that any amount or any other money is borrowed for the purpose of construction, acquisition, etc. of the house property by one person from another. There must be a real transaction of borrowings and lending in order to amount or to any borrowings. Amount of interest payable yearly should be calculated separately and claimed as deduction every year. It is immaterial whether the interest has been actually paid or not paid during the year. Interest attributable to the period prior to completion of construction. So, it may so happen that money is borrowed early and acquisition or completion of construction takes place in any subsequent year. Meanwhile, the interest becomes payable. In such a case, interest paid or payable for the period prior to previous year in which the property is constructed or acquired will be aggregated and allowed in 5 successive financial years starting from the year in which the acquisition or construction was completed. For example, the SSC took a loan of rupees 3 lakh in April 1999 from the bank for construction of the house on a piece of land which he owns at Meerut. The land carried interest at the rate of 15% per annum. The construction is completed in April 2001 and the house was given on rent from May 2001. So, meanwhile, the individual has already incurred liability of interest of 90,000 for financial year 1999, 2000 and 2001 and 2000 to 2001. So, because of the above provision, the SSC can claim a deduction in respect of this interest of rupees 90,000 over and above the yearly interest in 5 equal installments of rupees 18,000 each starting from the assessment year of 2002 and 3. As I gave the example. So, if let us see this example, the SSC took a loan of 6 lakh on April 2007 from the bank. The loan carries interest at 10% per annum. The construction is completed on 2009 and the entire loan is outstanding. So, compute the interest allowable for the assessment year. So, first we will see the interest for the previous year, that is 2009 and 10 on 6 lakh at the rate of 10% would be 60,000. Then interest for the pre-construction period from 1st April 2007 to 31st March 2009, that is for 2 years, it will be 1,20,000. Then 1/5, that is 5 consecutive successful 5 successive financial years will be allowed. So, for this year the 24,000 will be allowed. So, total interest allowable will be 84,000. The last one is the computation of income of property which is self occupied for the residential purposes or could not actually be self occupied owing to employment. So, in so far as the income from self occupied property is concerned, the same is taken as nil. The only deduction permissible against this nil income is interest on borrowed capital, which can be up to rupees 3 lakh or 1,50,000. No other deductions for self occupied property is permissible, hence only interest claim would be available for the set off or carry forward if the conditions mentioned have been satisfied. So, when the annual value of such house shall be nil, as I discussed, where the property consists of the house or a part of the house which is in occupation of the owner for the purpose of his own residence or no other benefit is derived therefrom, or cannot actually be occupied by the owner by reason of the fact that owing to his employment or business or profession carried on at any other place, he has to reside at that place in a building not belonging to him. So, the annual value of such house or a part of house shall be taken as be nil. So, this was the conditions for where the deductions can be allowed and how the computation of income can be done in 4 categories. So, this was for today's lecture. Thank you.